Well, hello, traders and investors. I'm L.A. Little, and this is your daily NeoTA wrap. Take a look at these markets, doing it from a neoclassical perspective. And what does that mean? It means we look at all three time frames, we look at supply and demand on the charts, we use the neoclassical model that I built to figure out what should happen, what the probabilities of that happening are, and does it not happen or does it happen? That's the test, and use that information to make decisions about the future. You can do it on any time frame. When I say any time frame, daily, weekly, monthlies. You can do it intraday, 5, 15s, 30s. It doesn't matter. Model works the same across all of them. All you have to do is pay attention to what the market's trying to tell you. How do we do it? Well, we do it here on TA Today with our tools that I built initially for myself. Now are services that you can use. If I pull this over a little bit, there's a bunch of tools here. All these tools give you signals, monitor, you can go through them. They give you ideas, trading ideas, high probability events. You can get started. You can call a member if you want. You can email me, tat@ta-today. Learn more about what's happening. Use the knowledge, the value proposition we give to help you both in managing your portfolio and trading, if that's what you're trying to do. Let's get started here. We had a big down day again today, and it's the old story of you can run but you can't hide, right? It's almost 90% of the stocks down today. And asset classes, let's talk about that for a second. There used to be a time when portfolio theory was, it actually meant something. And that was the late 50s when they developed it, all through the 60s and 70s, 80s, even up and through the 90s. But then things started to change, and that is that more and more we saw correlated assets instead of uncorrelated assets. And so portfolio theory doesn't work so well. You can see it, today you can definitely see it. Everything's red. Right? Gold, silver, oil, TLT, bonds, stocks. It doesn't matter, right? You can run, but you can't hide. It's everywhere. And those correlated assets are directly tied to central bank intervention and the what shall we call it? Maybe distortions, the distortions they've created, the malfeasant investments that have been created as a result of it, the desire to chase return where there is little return anymore. It's all tied together, folks. And these non-correlated assets, if you think that you're going to buy bonds and you're going to somehow escape the wrath of the market if it falls down, the bonds are probably going to go with the equities. They've been going up with them. Do you really think the bonds are going to go that much cheaper? Yeah, they can make a little bit more of a dent to the top side, but it's getting hard. It's getting hard for those bonds to go up. I mean, unless you're going to go to negative rates, maybe that's where we're going. I don't know. But non-correlated assets are a thing of the past for the most part, and you have to recognize that. That's not where it's at anymore. So pretty big day down. Let's go look at the charts. I'm not going to go over those numbers. You had enough time to see them yourself. Let's see what the charts look at. S&P. Okay, so what are we doing here? Let's just go back to the neoclassical model. Let's think about what it tells us, right? You get a big down day. Volume pretty heavy. Then you go under, back over, you have less volume, and you do it where there was a bullish retest regenerate. What does that mean? That means that we came back into a swing point high that was broken, right? We broke out here, we broke out there. As we went over those, we come back in to test them again. It's more than 6 bars. Took a long time to do it. That's almost an automatic bounce. I told you that previously. That's exactly what we got. But then I also said, the thing you have to concern yourself with, I believe I said it here, I know I said it to members, is that it's the failed bounce, right, that you have to worry about. Does it come back? Does it break down farther? Well, in this particular case, it hasn't quite, quote unquote, done that yet, but it's back down there testing again. That's not what you want to see. Is that going to lead to a breakdown? It could. It's not necessarily going to. You didn't get a test of the lows today. You had a little bit more volume. So I think it's a toss-up here. We'll have to see what it wants to do tomorrow. The market is trying to price in what they expect to be, Federal Reserve potentially raising rates. Part of that is the case. Part of it, I think, is really tied to bonds. And we'll move to those in a second. So let's go to the other indexes and see what we got. Here's the NASDAQ. Now the NASDAQ has been a little bit stronger primarily because of Apple. Apple's been trying to push up. So you basically just got an inside day here, not nearly as ugly as the one as you saw just on the S&P 500. You had oil pushing down to day 2. The financials were taking a lump tied to those interest rate worries. And then the bonds, of course, were bleeding across everything. So inside day here, NDX looks even stronger if we look at it. Right, it's up at the top third of this. Again, Apple being the big weighting there. And the Russell pushes down and gets under back over. Now, the problem is it has more volume. And when you have more volume in the neoclassical model, that says that you had more sellers at lower and lower lows. And even though you didn't stay down there, there's no guarantee that you're not going to go right back down there and try it again. And so tomorrow you have to be on the lookout. The Russell is where you ought to be looking for the early weakness. And the Russell's bleeding because of the banks primarily. And the banks are bleeding as a result of oil market, potential defaults kind of stuff. Let's go look at the bonds, though, because I think this is the bigger story that's taking place out here. So let me pop my debt instrument shared watch list. What is a shared watch list while we're here? I have watch list. If you're a member, you have watch list here that you can share with other people. I have gobs and gobs of them I share, right? And those watch lists are things that I'm watching, things that I'm providing to you and others that I think are good ideas. And so anyway, the shared watch list, the reason I was going here is I want to look at the bonds. So the 20-year bonds, that's share something with 20-year bonds, volume comes out of these today. They break down under that Brexit move. And let's pull over a weekly chart so that we can get a real feel for this. So up until 2 days ago, bonds were holding this higher range. So they had a range up here and they were holding in it. You could either draw it, the majority of it was here. There was another little range on top about equidistant. Now you have a breakdown underneath, right? And that's even wider, right? So it's actually trying to come back to this high is what it looks like to me. And so range from a range perspective, this thing has broken back down, and now it, just like I've talked about a while ago, bullish retest regen. Here's a bullish retest regen on this prior swing point high. There was some decent volume on it. There's a lot of volume left at the top. I believe that's true. Let's make sure. 143, yeah. So, the idea that we can come back up there is true. We're coming down. We actually had some volume expand today. I don't think it's going to be as heavy. Actually, we can calculate it. We got 24 2 days, 12 times 5. It's about 60. Yeah, actually, it will be more volume as it's coming into this. So you kind of want to see it arrested fairly quickly and try to bounce back the other way. But so far, that's not what's happening. And the bonds, as they sell off, right, that's a result of fear of what's happening overall in the markets. And if we look at some of these others like junk bonds, you're starting to get a pullback in the junk bonds. These had a nice, big, strong run. Now they're getting a pullback. If we pull it back to the monthly here, notice that these bottomed at the beginning of the year. Where at? Well, when the market sold off hard, it was these guys leading the way, not junk in particular, but bonds in particular. And if we go back and we can pop up the TLT, the TLT, not nearly as bad, but the TLT was also selling off. Well, it had sold off previously. It was just down towards those lows and had already started to recover. It was the junk, the corporate debt, those bonds were the ones that people were starting to fear, and overseas bonds. So anyway, the point is that bonds right now are kind of in no man's land. If I pull the daily chart back up here, that's volume expanding. You're coming back into it. What can they arrest it at here? Well, Well, as they come into this area, this is where you would expect it to bounce from. Um, what I don't like about it is you're kind of starting to get deep into this on a weekly. You need to get the bounce back out of here this week. Otherwise, this is going to get deeper than it should, and that's not what should happen given the model. So bonds, I think that's the biggest worry out there. So tomorrow, if you're looking at these charts, if you're trying to decide, are we going to break down or not, I would argue that the two places to look is to look at the bond market, look at the small caps, use those as a guide as to what's happening. If we look a little deeper underneath the cover, you actually have, and I mentioned, I believe this last night, you actually have some trouble starting to take place in some of these other areas like the sectors. For example, if I go to the energy sector, the energy sector sold off pretty hard today. That bullish retest regenerate that was out there for the energy sector gave it up today, right? So you're underneath it. What does that mean? That means that the trend that was this way is more than likely this way on this time frame. So we're getting some damage on the short-term time frame, and we're starting to see that damage present itself as trend changing potentially on these. And when I say that, what I mean is, in the neoclassical model, trend is denoted by the H and the L's. That's a swing point high, this is a swing point low. It's an algorithmic calculation. The only way you change trend is you break something. You break it, that's when you get an arrow. You break a swing point high, you get over it, you have more volume. That says that this thing can continue. That doesn't mean it will, but that says it can, and that says that the trend now is up. Now in this case it was already up, so all you did was extend it a little bit farther. If you go here, right, you're going to break a swing point low. What does it mean to fail on a retest regen? What I just said is that what used to be up, what used to be that trend, no longer is that trend. It's something else. And so no longer is it this. It's probably more like this. When would it actually go sideways? When would this arrow turn to a sideways arrow like that? When it breaks a swing point low. This is a precursor. It's a warning sign. That's what it means to retest and attempt to regenerate. If you fail to and you break down, then you're probably going to go break a swing point low. So you're getting damage now was the point. And after that slight tutorial, that's what's happening out here. Needs to be arrested pretty soon, or you're going to see more damage in the indexes, not just in the sectors. That's it for tonight, folks. Let's see what she brings us tomorrow. Have a great one. I'll see you next time. Good night.